Good evening, students. Welcome to the session. I can see some queries. Yes, Purushottam, good evening. Good evening, Mansha. Yes, as per 270A, Mansha, there is misreporting of income also. The penalty on underreporting is 50%, but on misreporting, it's 200%. Yes. So you can go back and watch the class, Mansha, on the penalties. Good evening, Kaushiki. Good evening, Viraj. Everybody, have you revised? Yes or no? Okay. So what we are going to do today is we are going to look at the penalties. As I had told you in the last class, I will be covering today the penalties, transfer pricing assessment, and we'll be going little fast because these are some of the procedural issues. You can read it also, as well as you can. It's self-explanatory in a way. There is nothing much which I should be, putting my time into or explaining that. It's very, very simple because the most important part of the transfer pricing was the methods, the 92 CE, secondary adjustment, and the 94B, which is the thin capitalization rule, right? So that we have already done that. Now we are moving towards the documentation. That also I have important documentation part which is there. I have covered what is the CBCR, what is the master file, and what is the local file. All of that is being covered adequately. Now I'll be quickly moving towards the penalties which are there for the non-maintenance of this documentation. So what are the first penalties for the non-maintenance of the documentation? Let's try and understand that very quickly. So in case you are not maintaining the document which is there, right? In case you are not maintaining these documentation, then there is the penalty which is levied. First of all, there is the penalty which is there in the case of CBCR, which is very, very heavy. So let's just write down very quickly. And let me just put it here. Okay. So the penalty for non-furnishing of the report, CBCR report. Give me a moment. I'm just writing it down. Okay. Yes. So you can write down penalty, which is there for not furnishing the CBCR report. Penalty for not furnishing the CBCR, which is there is, in this case, the penalty will be failure to file the report, failure to file the report. It is 5,000 rupees per day if it is delay is not more than a month. Okay, or you can just write down here. Delay less than 1 month, it's rupees 5,000 per day. So you can see it's such a heavy penalty. Where delay is beyond 1 month, then it is 15,000 per day for period exceeding 1 month. And if there is a continuing default, then 50,000 per day. So even if the notice is served to you by the AO and you are not filing this particular report, then in that particular case, it will be 50,000 per day. Okay. Penalty for failure to produce the information. Penalty for failure to produce the information is also same. In case the AO is calling for this particular CBCR from you and you are not furnishing it, then it will be again 5,000 per day. But it is not in terms of the 1 month or beyond 1 month, it is directly 5,000. So penalty for failure to furnish. Penalty for failure to furnish the information called by AO. This is rupees 5,000. And if continue in default, then it's 50,000. Again, this is per day only. Okay, this is per day penalty. In case there is incorrect information which is furnished, penalty for inaccurate information, then it is 5 lakh. So because this transactions, the CBCR is applicable to the entity which has the high transaction, the threshold is very high. The penalties are also kept very, very high. Okay. Now, as far as the master file and the local file which is there, as far as the master file and the local file which is there, for that, the penalties are, so I'm writing for penalty for failure to maintain local file or master file or furnish correct information or disclose the information. It is 2% of the value of each international transaction. It is 2% of the value of each international transaction under 271 AA. And if you fail to furnish the information to AO also, or information to AO also, it's the same. 2% of the value of international transaction. But that is under 271G. Then it's not only this much. It's not only that you would face the penalty, which is 2% of the value of the international transaction. There is much more to that. And I'll tell you what. This is under 271 GB. All of these are under for CBC under 271 GB. So in case you fail to furnish the report, or in case the local file or the master file, or in case you fail to not furnish the information, or you have not disclosed the international transaction, okay, if all of these things are there, then in that particular case, that will be considered as the misreporting of the income. It will not just be the penalty. So there will be penalty, of course, for the 2% of the value of the transaction. But over and above that, there will also be the misreporting of income. So penalty for failure to keep and maintain the information and documentation will be there under 270A. So plus penalty at the rate of 200%, because this will be considered as the misreporting of income. Are we clear? So if there is any misreporting, then there is penalty of 200%. So failure to report any international transaction or specified domestic transaction would constitute under section 70A for failure to report any international transaction or the specified domestic transaction. Are we getting that? Then finally, in case you do not furnish the audit report under Form 3CEB, then the penalty under Section 271BA is rupees 1 lakh. Are we getting that? So penalty will be rupees 1 lakh. Now the penalty will not be levied in case there is difference in the method of accounting. Difference in the method of the TP, or if there is any variation which is proposed in the transfer pricing. So let's say, for example, if there is underreporting of income, which is because of the different arm's length price determined by the transfer pricing officer. So that would not be considered as underreporting under 270A, but the assessee should have maintained the information and document. Are we getting that? So if there is a failure to maintain the document, if you have not disclosed the transaction in your audit report or in your master file, then in that particular case, they will be considered as the misreporting of income, and you will have the penalty at the rate of 200%. But because the transfer pricing is a subjective provision, you may have different ALP than mine. So then in that particular case, if the variation is proposed by the transfer pricing officer, if there is by the transfer pricing officer, it would not be considered as underreporting. Underreporting of income if the documentation is maintained. So the condition is you should have maintained the documentation. In case you have not maintained the documentation, then of course it will be considered as directly misreporting of income. But just because the AO has determined the ALP differently than what you have submitted, that will not be considered as the underreporting. Viraj, penalty at the rate of 200% is applicable when you do not maintain do not disclose the transaction in your documentation. So the 200% penalty which is there is failure to report any international transaction. Clear, Viraj? Okay. Now, next is the transfer pricing assessment. Now, if you remember, we have done the assessment of under 143.3. We have done the assessment under 148. All of that we have done, right? But the transfer pricing assessment is little different. Now, if you remember, I'll take you, we will not write it over here because we have done the assessment procedures properly. So I'll take you over there directly. One second. Yes. So if you remember, we have done assessment under 143.2, we have done assessment under section 148, all of that. And then we have done the spaceless assessment also, right? Now the transfer pricing assessment, how is it different? Let's try and understand. So what happens in the transfer pricing assessment? Here the AO, while computing the arm's length price or while determining the arm's length price, section 92C gives the power to the AO to determine the arm's length price, right? Now, if the AO is determining the arm's length price, he can make a reference to the transfer pricing officer. The AO has the power to make the reference to the transfer pricing officer. Now, is it necessary always to make a reference to the transfer pricing officer? It's not always necessary, but the AO can make it. So the option is there to make the reference to the TPO. The option is given to the AO. He may or may not make the reference to the transfer pricing officer. So where there is an international transaction and if the AO considers it, that it is necessary that he may make a reference to the transfer pricing officer to determine the arm's length price, then in that case, he can make a reference to the transfer pricing officer under section 92CA. So in case if you see here, we can make a reference over here. Yes. So when the AO takes up your assessment, then he can make a reference to the transfer pricing officer at his discretion. It's not something which is mandatory, but he can make a reference to the transfer pricing officer. Now, once he has made the reference to the transfer pricing officer, then the transfer pricing officer will have all the powers as that too of the AO. Why the AO has to make the reference to the transfer pricing officer? Because AO may not be the suitable person to determine the arm's length price, and because of which he can make a reference to the transfer pricing officer who is very well specialist in making the transfer pricing assessment. But he has to obtain the approval before making the reference. The AO has to take the approval of PCIT or CIT. After obtaining approval from PCIT or CIT. And when such reference is made, TPO would then serve a notice to the assessee requiring him to give the evidence which he has relied on in support of computing the arm's length price. So because if the AO if the TPO issues the notice, then you will have to submit all your local file, master file, CBCR, all of that. Especially the local file under section 92D becomes a lot more important over here, because you will have to substantiate to AO how you have computed the arm's length price, which comparables you have selected, which method you have selected, why you have selected a particular method. So the TPO will issue notice to assessee calling for information. Are we getting that? Now the TPO will determine the ALP which are of the transactions which are identified in the course of proceeding. Well, let's say for example the assessee has not furnished the report, the TPO report, the TP audit report. Then in that particular case, the transfer pricing provisions will apply as if the transaction is referred to the TPO by the AO. So in that particular case, the TPO directly can take up this assessment in case the assessee is not furnishing the report under 92E, which is the TP audit report. And after considering the assessee submission, the TPO will determine the arm's length price. And the TPO will issue the order to the AO, and the AO shall proceed to compute the total income in conformity with the TPO's ALP calculation. So, TPO will determine the ALP. TPO will determine the ALP and then will pass the order. So, AO to incorporate TPO's order, ALP, and pass final order. In the case of faceless assessment, the TPO will be who? How will the AO make the reference to the TPO in the case of faceless assessment? Do you remember that? Yes, do you remember in the case of faceless assessment, how will the AO make a reference to TPO? Whether he will make a direct reference to the TPO? Yes, past. How it will be in the case of faceless assessment? Yes, fast. Do you remember that? I'll take you to the faceless assessment here. Yes. If you see here, I have made the transfer pricing case also here. We have done the DRP, but before that, it was the transfer pricing assessment. If you remember, what was it? So here the AU which is there is the AU. The assessment unit has the AOs. And in case AU wants to make the reference to the TPO, then it will have to request for the technical assistance from the technical unit. The TPO will be sitting in technical unit and it will request to NFAC. NFAC will then assign the case to the TPO. Because, no, not NCLT. Geeta, it's not NCLT, it is the NFAC. Yes, Purushottam, either TU or AU. Yes, correct. Faceless assessment was entirely completed, Viraj. Okay, so this is how the actual reference will be done. And the TPO has to pass the order at least 60 days prior to the time limit for the AO's order. So he will have to pass order at least 60 days prior to AO's time limit for passing order. Okay, so if the AO's time limit is, let's say, 31st December, then the TPO will have to pass the order at least 60 days prior to that. Are we getting that? So that the AO gets the time to pass the order. Clear? And the AO can also rectify the mistake which is there in case there is any mistake apparent from record in its order. Fine. So here you can write 60 days prior to AO's time limit for passing order under section 153. The time limit for passing order is under 153, right? Which is, what is the time limit for passing of the order under 153? What is the time limit for 143 order? We have done that. What is the time limit? You can't remember? We have done this all of, right? What is the time limit for passing order under 143.3? It is 9 months. 9 months from the relevant AY, and in case of 148, it is 12 months. In case of 148, it is 12 months, if you see. So in case of regular assessment, it is 9 months from the end of the relevant AY. Clear? So that is how the TP order function. Now, once the TP order is passed, the AO will incorporate that order and pass the order, final order, which is there, right? And then the regular proceedings as we have it under NFAC, that will apply. Then in case the AO, in case the assessee is not happy, in case the assessee is not satisfied with the order of the AO, then he has two options. Before the AO passes the final assessment order, if you remember, we have done here the procedure of the dispute resolution panel. So in case of the transfer pricing, where the eligible assessee is a foreign company or a non-resident, then in that particular case, if the eligible assessee is there, then the application can be made to the dispute resolution committee. The application can be made to the dispute resolution committee. So the AU will prepare the income and loss determination proposal. It will be sent to eligible assessee through the NFAC. Now, the draft assessment order which is passed after receiving the objections of the assessee, the NFAC will send the objections to the AU, and AU will prepare the draft assessment order. The assessee has an option to either file his acceptance or make an application to the dispute resolution procedure, DRP. He can also make a reference to dispute resolution committee also, which is different from DRP. So eligible assessee has the option either to file the acceptance, either to make an application to DRC, which is dispute resolution committee, or he can file the objections to the variations proposed to the dispute resolution panel within 30 days of the receipt of the draft order. In case he goes to the, or he can, if he files his acceptance, the AO will proceed to pass the final assessment order. And if the AO passes the final assessment order, he has an option to go to CITAP. He has an option to go to CITAP. So if you remember, we have done, if the assessee makes the objections to the variation proposed by the AO, he can go to DRP. DRP is a collegium of 3 revenue members. Within 30 days from the receipt of the order, he has to go DRP under 144C. DRP can confirm, reduce, enhance addition. He cannot set aside. He can consider the additional ground. And within 9 months from the draft order, the DRP will pass the order. The DRP will issue the directions to the AU through the NFAC. And based on the DRP directions, the AO will proceed to pass the final assessment order within 1 month of receiving the DRP direction. Now that order is not appealable before CITA. It is only appealable before the ITAP. So DRP order is binding on the income tax officer. Only the income tax officer, the assessee can appeal against the DRP order. That too directly before the ITAT. The AO cannot appeal before the DRP order. against the DRP order, the AO cannot appeal it. Only the assessee can appeal it. Okay. So the AO is bound by the directions which are issued by the DRP. Are we clear? The other option is he can go to dispute resolution committee or he can go to the CIT appeal after accepting the draft assessment order which is issued by the AO. Fine. For the dispute resolution committee, if you remember, we had done that where the variations proposed are less than equal to 10 lakh or where the total income is less than equal to 50 lakh, only then you can go to the dispute resolution committee. And once you have gone into the dispute resolution committee, then in that particular case, if the person who is there only should be a non-resident and not a foreign company. It's for the non-resident, which is other than the foreign company, where the TP additions or adjustments are made. Right? So in that particular case, you can go to the dispute resolution committee. So you have three options: against the transfer pricing order, which is passed by the TPO, and finally, which is incorporated by the AO. Either go to dispute resolution committee if your total income is less than 50 lakh or your variations are less than 10 lakh. Or you can go to DRP against the draft assessment order. You can make the objections to the DRP against the variation proposed or accept the order, draft assessment order, and go to CITA once the final order is passed. Are we clear? Yes or no? Any questions so far? So is the TP assessment clear? Okay, Viraj got it. Yes, 9 months, 148, 12 months. Yes, Purushottam. Can I go to TP assessment which involves GAR? Can I go to DRP or only option with IT80? No, you can only go to IT80, Purushottam. You cannot go to DRP in that particular case because that is a specific provision under 144BA. Okay. Now again, I'm moving into the transfer pricing, the last portion which is there in the transfer pricing after penalties and the TP assessment. The last part is the alternate dispute resolution mechanism. Now, what is the alternate dispute resolution mechanism which is available under the transfer pricing? So, one is safe harbor. Safe harbor provisions which are there. Now, what are these safe harbor provisions which are there? Let's try and understand. So, safe harbor means that the income tax department will be issuing the appropriate margins for the different businesses which are there. So safe harbor means the prices or the markups which are there, the gross profit markups which are there, these are issued by the income tax department or the CBDT, not income tax department, but the CBDT. Now what CBDT do is, let's say for example, for the computer software business or for the information technology enabled services business, the income tax department or the CBDT will say that the accepted margin is cost plus, let's say 17%. If you show cost plus 17%, meaning you enter into an agreement with the CBDT that you are intending to opt for the safe harbor rules. You enter into an agreement with the CBDT that you intend to opt in for the safe harbor rules. And once you opt in for the safe harbor rules, then the CBDT will say, according to us, the markup on the computer software business is, let's say, cost plus 17%. Now you accept that you will offer your profits or you offer your transfer pricing ALP in terms of cost plus 17%. So you agree that your ALP will be at cost plus 17%, not more, not less than that. And if you go as per the safe harbor, the CBDT agrees with you that we will not make any disputes with you. So no variation will be proposed, as is your ALP will be accepted, because what we are saying you are accepting. So if you go as per us, then we will also not trouble you. If you do not go as per the safe harbor rule, the income tax officer or the AO or the TPO has the power to redetermine your ALP. What according to him should be the ALP, he will go ahead and determine it. He will select his own comparables, he will select his own margins, he will make the own selection of his method. But if you agree with the CBDT that we are opting for safe harbor provision, and the CBDT will say that, okay, according to us, they publish this particular pricing every year on year. For AY 22-23, they have not published it. And so likewise for the AY 23-24. So if they have not published it, then in that particular case, you will not be able to opt in for that safe harbor provision. But in case it is there, then the CBDT usually publishes it year on year. And once it publishes it, then you can opt in for those particular provisions. Are we getting that? So that is the meaning of the safe harbor rule. That means you are accepting the pricing which is declared by the CBDT. Clear? And then there would be no dispute resolution. So it's the alternate dispute resolution in order to reduce the dispute if you go ahead and agree with us. So that is the safe harbor rule. It's just the meaning I wanted to tell you, because any which ways their prices are not notified, so it is not actually applicable. Then the advance pricing agreement. So just like we have the advance ruling, right? Just like we have the advance ruling, we have the advance pricing agreement also. Now, what are advance pricing agreement? Let's try and understand. So, do you know what is advance ruling? Yes, do you know what is advance ruling? Yes or no, fast? So see, we have now a board for advance ruling, right? We have a board for advance ruling in relation to a transaction which is undertaken by a non-resident applicant. We will talk about the advance ruling also in 5 minutes. But in advance ruling, before you undertake a transaction, or even if you have undertaken a transaction, if you're not sure that what will be the tax implication of this transaction, if it's a new transaction for which there is no predecessor, the judgment which is there, precedent which is there, so in that particular case, you can go and request the advance ruling authority or the board for advance ruling as they call it now, and ask them or request them as to what will be the tax implication of so and so transaction which you undertake. So the board for advance ruling will issue you this ruling, based on which you will at least have the certainty prior to undertaking the transaction itself as to how the taxability is going to happen. Similarly, for the transfer pricing cases, we have the advance pricing agreement, which is APA. Now, what is advance pricing agreement? Advance pricing agreement is an agreement between the taxpayer and the tax authority as to what will be the TP method for the given transaction which should be applied in future. So the assessee is entering into an agreement with the tax authority to get the certainty from them as to how would they apply the transfer pricing methodology on the transaction. So there are two kinds of APA. There are two kinds of APA which are there. The one is the unilateral APA and the second one is the bilateral APA. What do we understand by the unilateral and the bilateral? Unilateral means, let's say for example, it's an Indian company and I enter into an APA agreement with the CBDT and I request CBDT to give me the certainty in terms of how would they apply the TP method on the transaction I have undertaken. So that is the unilateral. The bilateral means what? Not only me, but my US company with which I have the transaction. So the transaction is between the Indian and the US company. Now, I would request the income tax authority to give me the ruling, the advance pricing agreement. I want to sign with you the advance pricing agreement in terms of what methodology would you apply. And simultaneously, it should not only apply to me, but my US company also. So US company will enter into an agreement with the US government. I will enter into an agreement with the Indian government, and Indian government and US government both will agree between them through the mutual agreement procedure as to how they would look at the transaction from the transfer pricing perspective, so that there is symmetry between the application of TP provision. It should not happen that the Indian authorities are using the RPM and the US authorities are using the profit split method. Here the pricing is different, there the pricing is different. And then here I'm also making the secondary adjustment. There also the profits are different. So that will create a lot of issues in terms of the businesses to be carried on, because there will be differences in the pricing which is there in both the countries. So that is there are the two kind of APAs which are there. Now, how does the APA happens? Initially, a person who has undertaken an international transaction will request for the pre-filing consultation. Before he enters into an APA, he will enter into a pre-filing consult to decide as to what will be the scope of agreement, what are the transfer pricing issues, what are the international transaction, what will be the broad terms of agreement, so as to discuss whether they should enter into an APA or not. So the APA which is there, the pre-filing consultation stage in the APA which is there, that will not bind either the CBDT or the taxpayer. It will also not mean that the taxpayer has actually applied for APA. It is just to check the viability of the agreement by both the parties. That is the pre-filing stage. And only then, if you are satisfied under the pre-filing consultation stage, you can make an application for the APA. So it can be filed before the first day of the previous year, in respect of the transactions which are undertaken, or before undertaking any transaction. You can file the APA application before either undertaking the transaction or before the first day of the previous year, which is 1st April. Also, you can withdraw the application at any time. So APA can be withdrawn. Then you go for the application to be filed before 1st April or before undertaking the transaction. This is for continuing transaction, right? You can withdraw the application also. Withdrawal is possible. So you can withdraw the application at any stage before the finalization of the agreement. Before finalization of the agreement. And then the terms of the agreement will be decided, whether what are the international transactions covered by the agreement, how the arm's length price is to be determined, what are the critical assumptions on basis of which the arm's length pricing is determined. Okay. And then once the APA has been entered into, annually you have to furnish an annual compliance report. This is APA entered, and then you have to submit annual compliance report in order to satisfy the tax authority that you are following the agreement term. In fact, the tax authorities may also carry out the compliance audit by the tax authorities in order to check that we are complying with the agreement entered into with the government. Are we clear? So that is how the APA works. Now the APA which is there is valid for a period of 5 years. The APA is generally given for a 5-year period. So in case you are entering into an APA, that is generally given for the 5-year period which is there. Okay. It can be less, but it can be maximum for a period of 5 years. And the APA is binding on the assessee as well as the principal commissioner or commissioner of income tax. This is binding on assessee and PCIT or CIT. It is not binding on tribunal or the appellate authorities. Okay. Also, there is one more provision. You can enter into an APA for the past 4 years also. It's not just that it is for the future 5 years, but you can enter into the APA for plus past for previous year. This is called as the rollback provision. Rollback provision means that you apply the APA even to the past years. What are the conditions for applying the APA to the rollback years, which is there, or rollback provision? Conditions for applying the rollback provision, that the international transaction is same as the international transaction of the APA years. So here the conditions are international transaction is same as APA years. Also, you have furnished the return of income before the due date under 139(1). Furnished the return of income under section 139(1). It could be a revised return, but it cannot be a belated return. You have furnished the audit report. Furnished the TP audit report. You have furnished the ROI, you have furnished the TP audit report. And the determination of ALP for those years should not be resulting in reducing the total income or increasing the loss. ALP determination should not result in reducing total income or increasing the loss. Plus, the ALP determination should not be a subject matter of appeal before ITAT, and the ITAT should not have passed the order disposing of the appeal. So, ITAT should not have passed order disposing the appeal. Okay. So, in that particular case, if you fulfill the condition, then only you can go for the rollback years. And how will you give effect? Now, the question to you would be that how will I give the effect, ma'am? We would have already filed the return of income for that year. So, how will we go ahead and give effect to the rollback provision? So, in that very case, you are required to file the modified return. You are required to file the modified return in respect of the rollback year, giving effect to the APA. Are we clear? And in case the appeals are pending, let's say before CIT, ITAT or High Court for a rollback year, then the appeal, to the extent the appeal relates to the transfer pricing, it shall be withdrawn. So, the appeal shall be withdrawn. Okay. And in case the appeal is pending by the AO, then that appeal also needs to be withdrawn. Are we clear? And the AO will also give effect in case the assessment proceedings are pending. Then the AO will also give effect to the APA provision by modifying the assessment order. Are we getting that? Are we clear? Any questions, any doubt? Now, the APA which is there can be entered into by the entity which is entering into agreement. Let's say, for example, if there is entity A, which is getting amalgamated with entity B and becoming AB. Now, A has entered into the APA, but now it is getting amalgamated with B. So, can AB enter into APA? The answer is no. The one who has entered into APA, only the APA will apply to it. The APA will not apply to AB. Similarly, let's say, for example, if there is entity AB, B demerges and forms the B Limited. Now, AB would have entered into APA. Can B apply the APA? The answer is no. The APA is only binding on the entity which has entered in. Clear? Any questions, any doubt? Yes, no doubts. Is the transfer pricing provision clear? Okay. So it's very self-explanatory, nothing much. What I have told you, you have to just revise this much. And this should be sorted because these are the small provisions which are there on APA and all of that. Okay, maybe you can just quickly revise from the notes I have given you instead of spending too much time on that. We have done the considerable questions, so even that is sorted. Okay. Now, the next topic which we are moving to, which is again a very small topic, which is the advance ruling. So, advance ruling is similar to the APA only, but it has undergone the change. Earlier, it was authority for advance ruling. Now we have board for advance ruling. Now, who is the applicant in case of the board for advance ruling? Who could be the applicant? A non-resident in relation to a transaction which is undertaken or is proposed to be undertaken. For a transaction undertaken or even proposed to be undertaken. It can be a resident. It can be a resident also for determining the tax liability of a non-resident which the resident has taken the transaction with the non-resident. Resident for determining tax liability in relation to transaction with non-resident. It can be a resident in respect of or in relation to a tax liability of the resident applicants arising out of a transaction which is undertaken or proposed to be undertaken by that resident himself. So a resident can also apply for the transaction which is in relation to his particular liability also. But in that particular case, the tax liability should be more than 100 CR. In case tax liability exceeds rupees 100 CR. Are we clear? Then it can also be the public sector company. It can also be a public sector company, PSE, in respect of a transaction which is undertaken by the public sector company. It could be a public sector company also. Also, it could be in respect of a transaction or an issue relating to the computation of total income which is pending before the AO or the ITAT, and such determination shall include the determination of the question of law of fact. So, a question pending before income tax officer or the ITAT. Okay, or income tax authority we can write. Or the ITAT. Or it can also be regarding the GAR determination. For the GAR determination also you can approach the board for advance ruling. So whether an arrangement is impermissible avoidance arrangement or not. So a non-resident, a resident, a PSU or PSU but only in relation to the question which is pending before the ITAT or the income tax authority. And a resident or non-resident in relation to a GAR determination. Both R or NR both can apply. Are we clear? So you can either go for the normal route, which is the appeal or revision mechanism, or you can go for the board for advance ruling. Now, what are the fees for the advance ruling that is given in your module? So I am not repeating the fees which is there, but it starts from 2 lakh. Once you pay the fees and you make the application, then the board for the advance ruling, the bar, on the receipt of the application will send a copy to the principal commissioner or the commissioner of income tax. It will call for the relevant records, and based on that, it will either accept or reject the application. And any proceedings which are pending before the income tax authority or tribunal or any high court, So in that particular case, that application will not be allowed. So application not allowed if proceeding pending before the income tax authority or ITAT or the High Court or Supreme. In that case, the application will not be allowed. The application will also not be allowed if it is in relation to determination of fair market value of the property. That kind of application will also be not accepted. Or it will also not be allowed if transaction is designed for tax avoidance. In case the transaction is designed for tax avoidance, the application will be rejected, except in the case where it is on the issue of GAR. Fine. So once the application is rejected, then you cannot proceed further. If the application is allowed, the board would decide and will give you the advance ruling on the question. Now that is decided within 6 months. The time limit is 6 months. Passing the order is within 6 months. This is an alternate dispute resolution mechanism. And this will also be in all faceless manner. Are we clear? So in case you are aggrieved with the order of the bar, then you can go before the High Court. So the applicant who is aggrieved by the ruling pronounced by the bar, then you may appeal to the High Court. So this is the bar order. The time limit is 6 months. I will put it here. 1 second. Bar order time limit is 6 months, and you can appeal directly to the High Court. You can appeal to the High Court within 60 days. "60 days from the date of communication of the order." Are we clear? The delay can of course be condoned by the High Court. Any doubt, any question so far? Yes. Any doubt, any question? It is binding again on the assessee who is obtaining it and on the principal commissioner. Clear? Yes. Any doubt, any question? Yes, fast. Are we clear till now? It was, you may find it little, fast this, but this was very procedural thing. You can just read it from the notes I have given you. I have given very simple notes for you so that you can revise it on the last day of the exam also from my notes. Fine? Yes or no? Are we clear? Because then we are moving towards very important topic now. Yes, clear, Viraj? Everybody? Yes or no? Fine. Fast. Now, let's take a 1-minute break before we move on to very important area, which is the charitable trust. So I'm taking a minute break for you so that you are refreshed, and then we can start with the new topic. Meantime, in case you want me to ask something, you can please put your questions in the chat box. No, you cannot make revision against once revision order is passed. You can directly appeal before the ITAT, Purushottam. A revision order cannot be revised again. Yes, anything you want to ask? Is it clear? How was the transfer pricing chapter for you? You have revised or not? Yes. Have you been able to understand the transfer pricing portion very correctly? Income tax part. Kaushiki, yes. Income tax, international tax also, have you revised? because both of these are very new areas and you should be, very comfortable with it, because these are something, cash marks. Because if it comes in exam, there cannot be many, adjustments to that. You can easily fetch marks in case you're very clear with the concept. Okay, Purushottam, good. Yes, good evening, Jacob. Good evening, Anarga. Good evening, Geeta. Fine. Shall we move on to the charitable trust? Are you refreshed and charged up? Because this chapter has so many amendments that I do not want you to lose your mind even for a minute. Are you recharged? That's why I gave you 1 or 2 minute break. Okay, Viraj. Purushottam, you can write an email in case you have any questions. The questions would directly reach to me, so do not mind. You can just write an email approaching me through the email ID which is given. Yes, understandable, Viraj. It's not sufficient time. It takes time to type the queries. You can reach out to me, definitely send your queries. I would be happy to answer it. But just mark that the queries are relating to me so that the ICI can forward it. Clear? Email ID is of the Board of Studies. I'll give you the email ID in the last class. And then, you can send it out to them. Okay, shall we start? All charged up, geared up? Yes. A very important topic and much expected question in your examination on charitable trust. One question will be short, I think, there, because this is the amendment area which is there. So this is something which is very important. Yes, shall we start? Okay, let's quickly start with it. Kaushiki, I may not have seen it because was keeping little busy. I would look into it and will accept it for sure. In case you want, you can just send me a hi so that I know you have sent it. Okay. Purushottam, how do you remember the section? It comes with the experience, Purushottam. Also, while I'm teaching, I'm accessing the material as well simultaneously. So I remember the section because of the experience it is. But how can you remember for examination? See, what I used to do is when I was doing my CA final back those days, what I used to do is I used to make a list, okay, for the direct hands. In that list, not only sections I would use to write, I would also use to write the timelines for the assessment procedure for the appeal and the mistakes I used to make while solving the question. So that was a particular book which I had for the direct text, which was separate than my regular notes, where I was just preparing that list, okay, for the mistakes I was making, for the time limits, and for the sections. And I would use to daily look at it, not only for that, but even for the company law. Because GST also, so for all these three, for GST, for income tax, and then for the company law, I used to do it like that. And then I used to revise it daily so that I remember. Under company law specifically, I used to do it for penalties. So that's how you can also do it maybe. Virat, what is your question? Okay, so one question for this topic, as in I'm saying that this is amended, lot many amendments are carried out, so this could be an important area for exam. Geeta, yes, study material is more than enough for the international tax and transfer pricing. It's very good. Yes, thank you, Kaushiki. Okay, let's start. Let's start. I do not have much time then for the charitable trust. I have to finish it by day after tomorrow. Okay, let's start. Now, what are the kinds of trust? public trust, private trust. There are two kinds of trust which are there. One is the public trust and second is the private trust. Now, the private trust which are there are for the independent families which are there, or for the private members which are there. Generally big business houses, they have their private trust where they hold the shares and where they carry out their succession planning so that their business passes on to the ultimate beneficiary. So these are the kind of family trust which are there. So these are in the nature of the private trust. And then the public trust which is there is the charitable, religious, medical, hospital, or this educational institution which are for the general public. So these are basically the two kind of trust which are there. One is the private trust and the second is public trust. Okay. In the public trust, the beneficiary is the public. In the private trust, there are specific persons which are beneficiaries. Fine. Now, moving on first towards the public trust which is there, because this is the more important area. This, of course, we will do it day after tomorrow along with the political parties. But this is something which is very, very important. Now, how I'm going to divide the lecture is we are going to little extend it today also the lecture and maybe tomorrow also, because it's a huge topic we are having today and day after tomorrow, right? The class. So how we are going to divide it, this particular topic is today we are going to solve the questions on the charitable trust. Number one, we are going to discuss about the taxability of the charitable trust. And in the day after tomorrow class, we will do about the registration of the charitable trust. We will be doing the exit tax or the tax on the accreted income. Number two. Number three is the disallowances or the related party transaction under section 13 and private trust, and of course the political parties. All that will be taken care day after tomorrow. Okay. So let's get quickly started. So today we are only focusing on the entire part of the charitable trust. How do you compute the income? Now understand that there are two regimes for the public trust which are there under the Income Tax Act. One is under section 1023C and second is under section 11 to 13. Now under section 1023C, there are the different categories of the trust which are covered. The section 1023C is which is there. That is for the purpose of the different category of trust which are there. Now, what are the category of trust? First category is the specific trust. Now, what are the specific trusts under section 1023C? These relief funds which are there where you make a lot of these donations. So these are like some of the specific trusts which are there. Which is, let's say, for example, these flood relief funds, flood relief trusts which are incorporated, some welfare trusts which are incorporated. So there are certain names which are there under 1023C. Which are only registered or which have the exemption only under 1023C. So these are some of the specific trusts which are covered under 1023C. Let's say the Prime Minister National Relief Fund Trust, the Prime Minister's Fund, or the Prime Minister's Aid to Student Fund. There are different names. Clean Ganga Fund, Swachh Bharat Kosh, or Chief Minister Relief Fund, for which you get even the deduction under 80G. They are registered under 1023C. So you as a donor gets the deduction under 80G, but as the as the recipient of that donation, these funds or these trusts or these institutions are registered under 1023C. Second is the education let me extend this. Second is the educational or the medical trust. The education or the medical trust which are there. So any university or educational institution existing solely for the educational purposes, which is substantially financed by the government, or any hospital or other institution for the illnesses, which is substantially financed by the government. So, educational or medical, substantially financed by the government. Third category which is there is the university or educational institution, which is solely for the educational purpose, or educational institution solely for the educational purpose, and the medical institution or hospital, where the receipts from these universities or the receipts from this hospital does not exceed 5 crore. Receipts less than rupees 5 crore. Here also receipts less than rupees 5 crore. Are we getting that? Where the annual receipts do not exceed rupees 5 crore. Now here it is very important to distinguish between this and this. If it is less than rupees 5 crore, my receipts are less than rupees 5 crore, then only I can get exemption under 1023C unconditionally. And the second category is which is substantially financed by the government. In case I am not substantially financed by the government, then if I am an education or medical institute, then in that particular case, my receipts, if it is less than 5 crore, then only I can claim the exemption unconditionally under 1023C. What do you understand by substantially financed by the government? If the government grant exceeds 50% of the total receipts. So in these cases, if government grants greater than 50% of total receipts, then only these are substantially financed by the government. In case we are not substantially financed by the government, then we look into this particular segment. Whether our annual receipts are less than 5 crore. If it is exceeding 5 crore, then will that mean I am not getting the 1023C exemption? No, I will still get it. But I will not get the unconditional exemption. If it is less than 5 crore, I don't need to satisfy any condition. There are no conditions. It's just like your agricultural income, which is without any condition. It is just like your any other exempt income, which is their interest income on NRE account. Are there conditions? No. The only condition here is that the receipts should be less than 5 crore and it should be solely for educational purpose. For the educational. For the medical also, there's no condition. It should be only for illness. And if I satisfy that particular small condition, then it's done. My entire income will be exempt without fulfilling any more conditions. Are we getting that? Now here there is an amendment. And what is that amendment? So prior to the amendment, it was initially 1 CR. Now it has been increased to 5 CR. The second amendment which is there over here. Earlier, what we used to do is, for educational, let's say I am having a medical university. Let's say KEM college. or let's say any other AIMS college, AIMS which is there. AIMS has a medical hospital also. AIMS has the university also for the medical college. Now, if I have the total receipts less than, if I have the receipts from, let's say, the educational institute less than 5 CR, medical institute less than 5 CR. Let's say from educational institute, I have the receipts of 2 CR. And from medical, I have, let's say, from the hospital, I have the receipts of, let's say, 4 CR. Now, individually, I have the annual receipts less than 5 CR. Less than 5 CR in the educational also, less than 5 CR in the hospital also. So earlier what we used to do is, we used to say that this is unconditionally exempt. We used to apply the limit of rupees 5 crore for each of the entities separately. But now that has been amended and explanation has been introduced to 1023C to provide that you need to look at both the entities in the aggregate. So if the aggregate receipts from both educational or the medical exceeds rupees 5 CR, even if it is less than 5 CR individually, then in that particular case, 1023C exemption will not be available. 1023C exemption will not be available. So you can write down over here. Combined receipts of A and B less than rupees 5 CR. So your combined receipts should be less than rupees 5 CR. Are we getting that? So my combined receipts should be less than 5 CR. Clear? So let me give you an example. Let's say I have a trust where I have the educational institution also, I have the hospital also. I have 3 crores from educational institution, I have rupees 4 crores from hospital. Now individually it is less than rupees 5 crores, but in aggregate it is exceeding, combined it is exceeding. So then in that particular case, it will not be exempt. So let's write the example over here. Educational, let's say rupees 3 CR. Hospital, let's say rupees 4 CR. Combined greater than rupees 5 CR. So in that particular case, you will not get the exemption under 1023C. Are we clear? Yes or no? Okay. Next is for the again the specific category here which is there. It's a general category, not the specific category, which is in respect of any other fund or institution established for the charitable purposes. Fund or institution established for charitable purposes. Second, any trust for the religious and charitable purpose. Trust which is established wholly for religious or charitable purpose. Religious and charitable purpose. or any hospital which is there, or any university which is there other than A and B. Any educational institution, solely for educational purpose, and hospital. So if I'm not covered within, I'm writing it, let's say 1, this is 2, 3, and 4. So I'm not covered within 1, 2, 3. So then I fall within 4. These are the general category. These were the specific categories. This is my general category. But for here, coming under 4, I need to obtain the approval from, I need to have the approval from the Principal Commissioner or Commissioner of Income Tax. PCIT or the CIT. I need to have the relevant registration. So unless I have the approval, unless I'm an approved trust, I will not get the exemption. Are we clear? So this is under 1023C. I will call this as first regime. And section 11 to section 13. I will call this as second regime. So section 11 to section 13 is the second regime. There we have again the charitable or religious trust which are there under section 11 to section 13. But more or less, the provisions under the first and the second regime are more or less the similar. Clear? Now the question which arises is, what do we understand by the religious and what do we understand by the charitable? Now we understand the meaning of religion. It is not defined, but it's more or less relating to temples, to some spiritual or devotion kind of stuff, right? But with respect to charitable, what is the charitable purpose? So charitable purpose is defined under section 215. Charitable purpose is defined under section 215. What does it include? Relief to poor, education, relief to poor, education, yoga, medical relief, preservation of environment and monuments, preservation of environment or monuments, and most importantly, advancement of any other object of general public utility. Advancement of any other object of general public utility. Now, what do we understand by advancement of any other object of general public utility? Now, courts have defined it or courts have interpreted this provision time and again. So how the courts have interpreted it? The courts have regarded this as that the advancement of any other object of a charitable purpose of general public utility would be something which is for the charitable purpose only, which is towards the charitable purpose only, which is for the general public utility. And section 2, subsection 15, the definition of charitable purpose, provides that the advancement of any other object of general public utility would not be considered as charitable purpose if what are the conditions? If it involves the carrying on of any activity, if it involves the carrying on of any activity in the nature of trade, commerce, or business. In the nature of trade, commerce, or business. If it involves carrying on of any activity in the nature of trade, commerce, or business. For a fee or for any other consideration, for a fee or any other consideration, irrespective of how the application of the income is there, irrespective of whether you apply it for the charitable objective or not, irrespective of the application of income. So advancement of the general public of any other object of general public utility shall not be charitable purpose if it involves the carrying on of any activity in the nature of trade, commerce, or business. Unless there is an exception to this. Unless when it would be regarded as the charitable activity. Exception means it is regarded as charitable purpose if the activity is undertaken in the course of carrying out of the such advancement of any other object of general public utility. Activity is undertaken in the course of actual carrying out of the advancement of any other object of general public utility. And second condition, it's an and condition. The aggregate receipts from the activity during the previous year does not exceed 20% of total receipts. Now, we will discuss on this. You have the provision with you. Did you understand this provision? Read it for a minute and let me know, have you understand this particular provision? Yes. So, advancement of any other object of general public utility would be a charitable purpose, unless it is in the nature of trade, commerce, or business. However, if the income which is there, if the activity is undertaken in the course of advancement of the general public utility, even if trade, commerce, or business is carried out, but it is towards the advancement of general public utility, and the receipts from the activity are in the nature of trade, the receipts from the activity are less than 20% of the total receipts. Let's say, for example, an institution has received 30 lakhs during the previous year 22-23 from the activity in the nature of trade. The total receipts are, let's say, 140 lakh. And out of 140 lakh, 85% was applied towards the advancement of the object of general public utility. Now, in this case, if you notice that if 140 lakh are my total receipts, 20% of that is 28 lakhs. But I have received 30 lakhs from the activity in the nature of trade. So therefore, even if I have applied 85% for the general public utility, but if my receipts from the trade, commerce, or business exceeds 20% of the total receipts, then I will not get the exemption under 11 to 30. I will lose out on the status of the charitable trust. Irrespective of the fact that even 85% of that I am applying for the charitable or religious purpose. Are we getting that? So what is to be looked into is that what is the total receipts I have. Whether 20% of that is what I have for the income from the trade or commerce. Are we getting that? Is it fine? Is it fine? What if, let's say, for example, let's take an example. If the main objective of the institution is relief of poor, and I receive 30 lakhs from the trading activity, so then will you apply this 20% threshold? If my objective is relief of poor, if I'm not falling within this particular clause, but I'm falling in this clause, and let's say my trading receipts are rupees, let's say 30 lakh. Let's say my trading receipts are rupees 30 lakh. Then in that particular case, the question arises, and let's say my total receipts were 140 lakh. So will this particular clause apply over here? What do you think? Yes, Anarga, I'll repeat again. No threshold for relief to poor. This, yes, Purushottam, yes, Geeta, you are correct. This is only for the advancement of general public. This particular clause which is there is only for this. This will not apply to this. So even if, let's say, I have the trading receipts which is which is more than 20% of my total receipts, still it will not apply because relief to poor is considered as charitable purpose, and there we do not require to import this. So Anarga, here what we need to see is whether for the, when I say it is for the advancement of any other object of general public utility, means I should not be carrying on any trade, commerce or business. And how do I ascertain whether I'm carrying out the trade, commerce or business or not? I have to see if the activity which is undertaken in the nature of trade, commerce or business, even if it is there, it should be for the carrying out of the advancement of other object of general public utility. And the receipts from the trade commerce should be less than 20% of total receipts. Why? Because I should not be principally doing the business instead of the charity. Clear? Now, what do we understand? Activity is undertaken in the nature of trade, commerce or business. Now, in this context, understand that they have recent important judgments which are issued by the Supreme Court. We are going to deal with those judgments now. Very important. These are the two Supreme Court judgments. One is New Noble Educational Society, which is of 2022. New Noble Educational Society. This is of 2022, and more recent than this is Ahmedabad Urban Development Authority. Ahmedabad Urban Development Authority. Now, what are these two judgments providing? First, we'll talk about, in respect of both of these judgments, what they are trying to say. So, the Supreme Court judgment in the context of New Noble, or for that matter, Ahmedabad Urban Development Authority, which is there. So, first I'll talk about New Noble Educational Society. Here, what they were interpreting is the section 1023C. Here they were interpreting the section 1023C for the educational institutions. Under New Noble Educational Society, they were interpreting this word solely for the educational institution. You can write down over here, refer New Noble case. This could also come in the exam as a part of the case law. So what was the discussion here between before the Supreme Court? Supreme Court in this case interpreted this word that the educational institution which says shall solely engage in the education or educational activities and not engage in any activity of profit. So the question before the Supreme Court was that whether when I say that it is existing only for or solely for the education, would that mean that such institution cannot have any other objective? Also, would that mean that it cannot carry out any business as such? So, under section 1023C, the exemption will not apply in relation to the income of the educational institution if it earns the profit and gains, unless the business is incidental to the attainment of the objectives. So let's say, for example, if I have the school and I have a publishing house for that school where I sell the books. If I sell the books to everybody, then in that case, I am doing a business. Then it is not incidental to education. But let's say, for example, if I am into the business of publishing, but I sell the books to the students of the school, where the business is incidental to the attainment of the education purpose. And I'm maintaining separate books of accounts for both the business, then that is allowed. But the question to the Supreme Court was whether it cannot engage in any other business or not. So the Supreme Court held that the education institution shall solely engage in educational activity, and not engage in any activity of profit. They cannot have any objectives which are unrelated to education. So Supreme Court had interpreted the term solely by laying down certain conditions, by laying down certain principles, that it should wholly engage itself in education and cannot engage in any activity of the profit. Where the objective of the institution appears to be profit oriented, then such institutions will not be entitled to approval under section 1023C. So if it is into any profit generating activity, then it may not be entitled to the 1023C exemption. So only when you are imparting education, and if there are incidental business or profits which are happening, such as sale of textbooks, providing school bus facility, which is incidental to the educational activity, then that is allowed as exemption. Are we clear? So that's what Supreme Court in this particular decision held that. Are we getting that? So you can write down over here. Write down. Noble case. The requirement of the charitable institution, or you can write, or let's write the educational institution. The educational institution shall solely engage in providing education. Shall solely engage in providing the education and not engage in any activity of profit, and not engage in any activity of the profit unrelated to the objectives of the education. From business unrelated to objects. And if it engages in profit oriented activities, then section 1023C, exemption will not allow. Will not be available. The profits should be incidental. The profits should be incidental to the educational activity. Example you can write. Sale of books, bus facilities. Okay. However, let's say, for example, where the institutions are providing their premises to, let's say, the businesses, to, let's say, the other institutions for carrying out the workshops, the seminars, then it is not incidental to the objective of education. Or you can write down over here, however, if the institute provide their premises for use by other institutes for conducting seminars or workshops, then the income derived cannot be characterized as education activity. Then it is not educational purpose or incidental to it. Fine. Yes, any question, any doubt? Is noble decision clear? Yes, libraries for public could be constituted as the advancement of the objective of the general purpose. Manisha. Yes, clear, very clear, Manisha. Yes, it's correct. Recent Chief Justice said that the purpose of education is solely charitable and not for profit making. That's correct. That's very well a correct point. Okay, any other question? Yes. Is the Supreme Court ruling clear? Fine. New noble clear? Yes or no? Okay. Now understand one particular thing. This new noble decision which is there in the context of the educational institution. This is in the context of the educational institution. Now, if you see the Ahmedabad Development, Urban Development Authority decision which is there, we are going to discuss both of this. That first, we'll first finish about the new noble. New noble is dealing with the scope of the exemption in relation to the educational institute, where the question was, what is the incidental activity in relation to education? Whether here you will apply the predominant test, whether here you will look into the fact that predominantly I am providing the education. If incidentally I am doing some business, that should be allowed to me. But the Supreme Court in that decision said no, you will not apply the predominant test under section 1023C. So you can write down here, predominant test not applicable. Solely means completely. Solely means completely. If the objects of the educational institution allow it to carry some non-educational activity, then you cannot be claiming the exemption under 1023C. The objects must relate to imparting of or facilitating the educational activity. There is no bar on generating profit. So you will say that, ma'am, then in that particular case, we cannot generate any profit. So the schools will function only for charitable activity. No, there is no bar to on the profits. But the profits should be generated while providing the educational facilities and the incidental income, which is also in relation to the education. So there is no bar on the profits. Let's be very, very clear. The Supreme Court is not saying that you should have bar on the profit. It is not a bar on the profit. But the profits should be generated in the course of providing the educational facility. So you can write here, no bar on generating profits, but profits should be from charitable or educational activity. So in exam, you can get a case study like this. Let's say there is a charitable institute. It has given the, it has earned, let's say, the profits of so and so rupees, let's say 100 lakh. And it has also given the institute for the workshops to the companies for carrying out the workshop. And it has claimed to, it has made the claim of the exemption under 1023C. And the AO has disallowed that. You are required to present your answer around that. So you will write this particular decision that the profits are not the bar. The Supreme Court never said that the profits are bar. What is the bar is that you should not be carrying out the business which is other than the educational. Are we clear? So New Noble has provided this particular ruling in the context of whether you have to look at the predominant test or whether you need to look at the objectives of the trust. Are we getting that? So this is something which is very, very important. Now, in terms of the Ahmedabad Urban Development Authority institution which is there, the Ahmedabad Urban Development Authority question which is there, what was the issue? There the issue was in respect of the institutions which are there or the trust which are there. When can an activity be considered as trade, commerce or business for the purpose of attracting section 250? Can you imagine how many pages judgment this would be? How many pages judgment this would be? This was 149 pages judgment. This was 149 page judgment which was there. In this particular ruling, the Supreme Court has done a fantastic judgment or analysis of the charitable institution. It went to the history of the tax exemption. This was a 3-judge bench of the Supreme Court, dealing with the concept of the advancement of any other object of genuine public utility. Here, the court noted that court went into the speeches of the parliament, it went into the memorandum to the finance bill, and it observed that the parliamentary rationale always was to create a bar on the general public utility charities from carrying on the activity in the nature of trade, commerce or business. So there is a prohibition from engaging in any kind of activity in the nature of business, commerce or trade. or rendering any service in relation to thereto, and earning any income by way of trade, commerce, or business. So, what is the implication of that is that income derived from the trade, commerce, or business. What does that mean? That it should not be motivated with the profit objective. If the fee or consideration is collected for the trade, commerce, or business, then in that particular case, it means that here the objective is to earn the profit. Here also, the Supreme Court disregarded the predominant test as to what you are predominantly doing. Supreme Court disregarded that test, as like in the Noble case. Here also, it disregarded this test. Under Ahmedabad Urban Development Authority also, the assessee had taken the argument that if predominantly we are not doing the trade, commerce, business, therefore in that particular case, we should not be disallowed the exemption. But the court disregarded that. Court clearly disregarded that. What the court's observation here was that the first consideration would be whether the activity is covered by the object clause. If there is a nominal markup, if there is a nominal profit over and above the cost, the activity may fall within the objective of the advancing the general public utility. However, if there is a significant markup over the actual cost, then we need to consider whether it is in relation to the trade, commerce, or business, and we need to apply that threshold of 20%. If the trust is carrying out the activity according to its objective and earning the income therefrom, there is no problem. It is for the charitable purpose. It is only when it is carrying out in the nature of trade, commerce, or business, and that particular trade, commerce, or business is not in regard to achieving the object of general public utility, it's not incidental, only there we have the problem. So the Supreme Court said that we are not precluding the assessee from carrying out any object of general public utility if the receipts do not exceed 20% limit. But trade, commerce, or business has to be ascertained in terms of whether it is in line with the objective of the trust or not. Are we getting that? Yes or no? Yes or no? Any doubt, any questions so far? Predominant test means check off that whether, if the assessee's argument is that if I'm doing majority, let's say 80% of my activity is charitable. If for less 20% I'm doing the business, then that should not hamper my exemption. So predominant test means predominantly if I'm doing the charitable activity, I should not be denied exemption. But the Supreme Court has rejected that. Purushottam, for the medical, there is no objective of carrying out solely for that. It is only that the medical objective, it should be for the illness. For the hospital, the only objective is that it should be for illness. Okay? Yes, any other question? Any other doubt? So this case was argued by the learned counsel Hari Salve. And here there were also references in terms of the bodies like ICAI, ICWI, ICSI, because there also the Supreme Court observed that a singular characteristic of ICAI or ICSI or whatever is the powers conferred upon them by the statute to prescribe the standard, to impose the disciplinary sanction. Thus, these statutory bodies are regulating the profession. They are regulating the profession to prescribe compulsory courses to be undergone before the individuals concerned are entitled to call themselves as CACS, whatever. Their job is to monitor the conduct of the member. And these activities does not tantamount to trade, commerce, or business. So the Supreme Court cautioned that while considering the nature of the activities, the regulatory bodies may also perform whether the kind of consideration charged is high or nominal. But if the level of the fees are significantly higher than the cost, such provision, such kind of income, where there is a high markup charge than the cost, would attract the proviso to section 250, which is it should not exceed 20% of the gross receipts. Similarly, for statutory corporations discharging public function, the corporations which are engaged in industrial development, housing development, supply of water, they also may carry out some trade, commercial, or business activity. But what is essential is whether it is for the advancement of the public purposes. And if it is for the advancement of the public purpose, it has to be excluded. So it clearly depends on the facts and circumstances of the case. What is important here is whether it is at cost with a nominal markup or significantly higher to determine if it falls under the mischief of commercial activity. So here you can write down whether markup on the cost is nominal or significant to determine if it is for commercial purpose or commercial activity. Are we getting that? Any questions, any doubt? Similarly, it is for the cricket associations, for cricket association like BCCI. Now here, there also it's the same thing. That what they are doing they are conveying the rights to the successful bidders for the broadcast with respect to the arrangement, right? So one needs to examine what is the proportionate division between the receipt and the expenditure in order to decide upon whether the activity is commercial activity or not. Are we clear? Yes or no? For temple Gurdwara, if they have rented their premises, again you need to examine whether it is in the nature of the commercial activity or not. Yes, Mansha, very good. Okay, so let's take a 5-minute break, not more. We get back in 5 to 7 minutes and then we start again. Okay. Yes, Mansha, if the markup is nominal, then technically it does not fall into the trade, commerce, or business. Okay. As per the trust, main objective is relief for poor, not the advancement of general public utility, but it is mentioned in the objective clause of MOA of the trust. Is it 20% of receipts condition will apply here? No. Purushottam, 20% of receipt condition will not apply for the relief for the poor. As I told you that I gave you the example also. If even if my receipts are exceeding 20% in case of the relief for poor objective, then in that particular case, the 20% clause will not apply. But the only thing should be that the objectives should be in line, the activities should be in line with the objective of the trust. The conditions will only apply, Purushottam, if the main objective is advancement of general public utility. If main objective itself is trade-off advancement, there cannot be trade-off advancement, Purushottam. Okay? Okay. Now we move on to the very, very, very important part. Now see, I'm not going to, tell you the theory on the charitable trust and tell you, okay, that this is what is the income, this is what is the application. We are going to look at directly the computation or the statement of total income for the charitable trust. And through that, we are going to understand the provisions. Fine? Okay. So let's start with it. Now, the first important point which comes under the charitable trust, which is under section 11, the income which is there from the income from the property held for the charitable purposes. Income from the property held for the charitable purposes. So income derived from property held under trust wholly or partly for charitable or religious purpose. Now, ideally here, if you see, this is income derived. Right? This is income derived. So here, your word used is income. Income generally means what? Gross receipts? Or does it mean the income after the gross receipts after the expenses? So income means what? Income means gross receipt minus the expenses, technically. But in terms of computing that 15% ad hoc exemption, there are two views to that. Whether 15% ad hoc exemption applies to the gross receipts or whether the 15% applies to the income from the charitable trust. Both the views, there are different opinions and therefore both views are possible. But at the ICI level, what we are going to do is, we are going to consider here only the gross receipts. So income here would mean the gross receipts. Fine. Here you will only include the gross receipts. Fine. Second, voluntary contributions. Voluntary contribution not forming part of the corpus of trust. So first is the income from property, which is the gross receipt. Second is the voluntary contribution. So income derived by a trust from voluntary contribution other than the corpus donation is the income derived from the property held under trust. That is under section 12. Are we getting that? So that is also considered over here. Now, what do we understand by the corpus of the trust? What do we understand for the corpus of the trust? So voluntary contribution which are received for the charitable or religious purposes, that will be deemed to be the income. However, corpus donation shall not be treated as income. There are two kinds of corpus donation. First, it will not be considered as income. Provided it is not considered as income, provided it is invested in the modes specified under section 11.5. Specified under section 11.5. So it should be invested in the mode specified under section 11.5. Now, what is section 11.5 talking about? So the 11.5 which is there is in terms of the specified mode where you can invest your funds for the corpus donation. So if you invest into that particular fund, then in that particular case, you will not be disallowed. Then it will be considered as corpus donation, and therefore there will be no inclusion in the income. There will be no inclusion in the income. Now, under 11.5, there are several securities, government securities, all of that are mentioned, under which if you apply your corpus donation, that will not be considered as the income. But if you do not apply in respect of that, then in that particular case, it will be considered as your income. So the whole point is that it should be for the 11.5 in which it is being applied. Now, what is the mode specified in the 11.5? Investment in government savings certificate, post office saving bank, deposit with the cooperative bank or scheduled bank, investment in the government security, investment in government debentures, public sector company, or the long-term infrastructure bonds. So mainly the government securities which are there or the bonds which are there. Right? So that is in the specified mode under 11.5. Are we getting that? The second category which is there, is for the repair, donation for repair and renovation received by a religious trust. So donations which are received by a religious trust for the repair and the renovation, that also will be considered as the corpus donation. That also will be considered as the corpus donation, and that also will not form part of the charitable trust income. So that also will not form part of the charitable trust income. Are you getting that? So if I have received for the donations for the repair or for that matter renovation of the trust, then in that particular case it will not be considered as the income which will form part of the charitable trust. Are we getting that? So this is something which you have to keep in mind. But again, here there are certain conditions which needs to be fulfilled. And what are those conditions? Just write down. So it should be used for the specified purpose. Which is, what is the specified purpose here? The specified purpose is very clear, which is the repair and renovation. So repair and renovation, which is the specified purpose. Second, in case this is not used for repair or renovation, in case this is not used for repair or renovation, then in that particular case, it should be invested in modes specified in the mode specified under section 11.5. In the mode specified under section 11.5. And what is the third condition here? Such corpus cannot be donated to any other trust. So you know that, right? If we donate to other trust also, then that is allowed as application of income. But in case it is received for repair or renovation, then you have to use only for that specified purpose. In case you are not using that, then it should be invested in the mode specified under section 11.5. Referring to house property income? No, I'm not referring to Mancha house property income. 22 to 54, no, I never referred that. Okay. Then, third one. The third income which is there is income from the government grants. Income from government grants. So that will also be included over here. Income from government grants will be considered as the income, or the subsidies which are received by the trust, that will be considered as the income. Right? Next is capital gains. Next is the capital gains. Now here, what you will include is net sale consideration. Refer application. Refer in the application. How about the reinvestment? Do we get exemption here under 5454F? That we are going to do in the application part, because that will not be counted over here. Here only you will consider the capital gain. Reinvestment will be considered as application of income. Anonymous donation. Anonymous donation. Now, anonymous donation, here understand one particular thing. In the case of the anonymous donation, how we have to consider? How we have to consider the anonymous donation? For the anonymous donation, there is the condition which is there, or not the condition, we can say there is the formula which is used for computing the anonymous donation. And what is that formula? Let's try and understand. So in case of the anonymous donation, either 5% of the total donation, either 5% of the total donation or rupees 1 lakh, either of these two amounts, right? Either of these two amounts, whichever is less, will be considered, whichever is higher will be considered. Whichever is higher will be considered. So, for the anonymous donation, what you will do is, you will consider 5% of the total donations. 5% of the total donations or rupees 1 lakh, whichever is higher, you will consider that. So you can write down 5% of total donation or rupees 1 lakh. Total donation here means my voluntary contribution, my corpus donation will also be considered, as well as the anonymous donation. All of this will be considered. So let's say if my total donation is rupees 5 lakh. So 5% of the total donation or rupees 1 lakh, whichever is higher, will be considered as the normal income. So 1 lakh is 5% of 5 lakh is how much? 5% of 5 lakh or 1 lakh. Obviously 1 lakh will be higher. So I will consider 1 lakh as the normal donation. The rest of, let's say the anonymous donation is 3 lakh. So rupees 2 lakh, the excess donation which is there. Rupees 2 lakh which is there will be taxed under 115 BBC. Will be taxed under 115 BBC. So anonymous donations which are there, the normal donation will be considered, out of the anonymous donation, 5% of total donation or 1 lakh, whichever is higher, will be considered as the normal donation, and rest of the amount will be considered as the excess. Rest of the amount will be considered as excess that I will not consider in the income. That is taxed at a flat rate of 30% under 115 BBC. At the rate of 30%. Now this will give me my total income. Sorry, not total income, my gross total income. Or let's say my total receipts. Not even income. Out of this, I will reduce ad hoc exemption of 15%. I will reduce the ad hoc exemption of 15%. Right? I will reduce the ad hoc exemption of 15% here. Now this 15% which is there, this 15% I can apply in the way I want to. This is an ad hoc accumulation which is given to me. So here I can use this in the way I want to. And in case I'm not utilizing it, I have to deposit it in the mode specified under section 11.5. Are we getting it? So 15% can be freely accumulated or set apart for application to charitable or religious purpose in India. This 15% which is there, I can use it in the way I want to. Right? In case I'm not utilizing it, I have to deposit it in the mode specified under 11.5. Clear? Now the balance 85% which is there. The balance 55% which is there, that has to be applied for the purposes for which the trust has been created. So that has to be applied for the purposes for which the trust has been created. Are we getting that? So balance 85% I will have to utilize for the objective of the trust. Now, what will be considered as the application of income? So here, there may be certain application which may be admissible and certain application which may be inadmissible. Are we getting that? Now, what do I consider the admissible expenditure which is there? Number one, the expenses which are there, the operational expenses, which are there, that will be allowed as the application of the income. Also understand one particular important point over here. With respect to the operational expenses, here, in case you fail to deduct the TDS, then the expenditure which is incurred, or you fail to pay the TDS, then 30% of the expenditure will be inadmissible. 30% would not be treated as the application of the income. It would be treated as the application in the year in which tax is deducted and paid. So, considered as application in year in which TDS is paid. Likewise, if you incur any expenditure in respect of which the payment exceeds the 10,000 in cash, where you make the cash expenditure over rupees 10,000, then that will not be allowed as the application of income. That will not be allowed to you as application of income. Under 48(3), same provision is applicable over here. This is provided in section 11 itself. Are we getting that? So this will not be considered as the application of the income. Well, let's say for example, you have set apart the amount, where you have set aside the amount, where you have set aside some amount, but you have not actually paid the particular expense. So the expense will be allowed to you. Any sum payable by the trust or institution shall be treated as application of income only in the year when sum is actually paid by it. So irrespective of the previous year in which the sum was incurred, irrespective of the method of accounting regularly employed by you. Let's say, for example, if the trust is accounting as per cash basis, if the trust is following the cash basis of accounting, then any which ways I will be claiming the expense on payment basis. Then any which ways I'll be claiming the expenses on payment basis. But let's say, for example, if I'm following the accrual method of accounting, mercantile system, then also I will not get to consider the expense as the application of income unless it is actually paid by me. So when I'm incurring the expenditure on the basis of the invoice, I cannot claim that as the application of income. This is the recent amendment which is there. So you can write down expense incurred not considered as application. Expense actually paid, irrespective of method of accounting. This is the latest amendment. So you may be given in the question that the trust is following the accrual method of accounting, but you will not allow the expenditure which is payable and not actually paid. Are we getting that one? Okay. Next, which is there is in the application of income. In the case of application of income, you will get, as I said, the operational expenses. You will get the operational expenses, but where you fail to deduct TDS or where the cash expenditure is there, then that will be disallowed. Next is capital asset acquired. Capital asset acquired. Capital asset acquired. Then in that particular case, you will consider this as the application of income. You will consider it as application of income. Are we clear? But the depreciation on such asset will not be considered as the application of income. Okay? So depreciation on the capital asset. So you cannot claim both the capital asset as well as depreciation on that. Are we clear? Okay. So capital asset which is acquired by the assessee, that will be allowed to you as the application. The cost of the asset can be considered as the application. Let's say, for example, if there is a charitable institution and it acquires a building, let's say for the hotel, not for hotel, sorry, for the hospital. Now, whether you can claim the cost of that, yes, you can claim the cost of that particular hospital which is there, the building which is acquired for that hospital. However, the depreciation cannot be claimed. Okay, the depreciation cannot be claimed. What about, let's say if the building has been acquired out of a loan taken from the bank. If the building has been acquired from the loan taken from the bank, I have taken the bank loan for acquiring the building, whether the building cost can be considered as the application of income? Yes. Mancha, over cash more than 10,000, it is fully inadmissible as we do under 40A3. Same way we will here fully disallow, not the excess part. Yes, whether if I have purchased the building. So I have purchased the building from bank loan. Whether I can claim the application, here if I acquire the building, I can claim. But whether building from bank loan, can it be claimed? Yes or no? What do you think? So when you take the bank loan or any loan, and any expenditure which is incurred from that particular loan, any expenditure which is incurred from that loan amount, any application out of the loan or borrowing is not to be treated as application of income. So application from loan or borrowing not to be treated as application. So this will not be allowed. What will be allowed is repayment of loan or borrowing. Repayment of loan or borrowing. So only when I actually repay the loan, that is considered as the application of income. What is the logic behind that? When I am taking the loan, is loan considered my income? If loan is not considered my income, then how can I, when I'm utilizing that loan, consider that as the application of income? If loan is not included in the income at first place, how can I consider the application from the loan as application from income? When I'm utilizing my income to repay the loan, that will be considered as the application of income. Are we getting that? So when I'm utilizing the loan amount, income for repaying the loan, that will be considered as the application of income. Getting it? Next is the amount which is forming the corpus donation. The corpus donation which is received. Corpus donations which are made. So corpus donation, whether for that will be consider it as application. So the amount utilized from the corpus donation which are received. Application made from the corpus donation, will it be considered as the application of the income? Yes. What do you think? Mansha, you are acquiring the capital asset. See, you have to distinguish between your normal business profession computation versus the charitable trust computation. In the charitable trust, you remember we used to prepare in CPT and IPCC the NPO accounts, non-profit organization account. There, did you prepare the profit and loss account and the balance sheet? No, we used to prepare the income and expenditure and receipt and payment account. If you remember, statement of asset and liability. Their receipt and payment account was more important. Because these not-profit organizations are not working for the profitability. So when you are computing the profit, that time you can say that, okay, we will consider the depreciation. Here what we are computing is the income which is left after application. The income which is not applied. So here we are considering the application of income. Depreciation is an expense. It is not an application of income. When I am allowing the entire capital asset as a cost in the normal book profits, what you do is in the normal tax computation, do you allow the capital asset as a cost? Answer is no. That's why you allow periodically the depreciation. In case, let's say for example, for 35 section scientific research, for 35 AD specified business, you allow entire capital asset as the expenditure. There you don't claim the depreciation then. For 35 AD and scientific research, do you claim the depreciation? No, because the entire asset is allowed to you as deduction. So when here also I am considering entire cost of asset as the expenditure or the application of income, then again I cannot allow the depreciation on same. Are we getting that, Mancha? Okay. What about the amount utilized from the corpus of the trust? The corpus donation received, the amount which is utilized towards that. Yes. Yes or no? Corpus donation which are received, application made from that. Yes. So, just like repayment of loan or borrowing, when corpus donations which are received is not considered as the income, the amount which is applied from the corpus donation will also not be considered as application because you're not including it in the income. So how can you say it is application of income? So corpus donation, no Manshad, will not be allowed. Okay. So application from corpus donation is considered as inadmissible application. However, let's say for example, when you are reinvesting the amount in the corpus donation in the mode specified under section 11.5, then it will be considered as application. So amount reinvested, amount which is reinvested in mode specified under section 11.5 to be maintained for such corpus then it will be considered as application of income because you are spending from that particular income itself. You are investing from the current year income itself. Next is donation to another trust, irrespective of the objective of the trust. Let's say my objective is religious purpose, but the trust to which I am contributing is having the objective of educational purpose. Then in that particular case, if I am paying the amount to any other trust or institution registered under section 12AB, it is important that that trust should be registered under section 12AA or 12AB. That will be considered as the application of income. And amount should not be towards the corpus. It should not be towards the corpus donation. Should not be towards corpus donation. It should not be towards the corpus donation. Okay, are we clear? So any amount which is credited or paid as a contribution with a specific direction that it shall form part of the corpus, that shall not be treated as the application of income for charitable or religious purpose. So amount which is there as a part of corpus will not be considered. You can write down paid towards corpus donation. If it is investment in the mode specified in 11.5 for the corpus, that is fine, but it should not be directly only for the corpus to any other trust. Okay. Any amount which is paid any amount which is paid out of the accumulated income. What is accumulated income? So the provision of the trust allow you to accumulate your 85% of your income for a period of 5 years. Right? So you can accumulate your income in the mode specified if you're unable to apply 85% of your income. And let's say, for example, you are setting it aside. You are accumulating it for, let's say, purchasing the building after 5 years. Then if you are accumulating it for a period of 5 years, then that is considered as the accumulation of income. Now, if you have accumulated the income, once you have opted for accumulation of income for the period of 5 years, and if out of that accumulated income you are paying to another trust, then in that case, that will not be considered as the application of income. So it should be out of the current year income and not out of the accumulated income. So once the accumulation option is opted for, so both regimes permit the accumulation of 15% of income for sure. However, 85% of income can be accumulated only for a period of 5 years. 15% can be accumulated freely. Now, the condition for accumulation is that the money which is accumulated should be invested in the mode specified under 11.5. And it should be applied for only the purpose for which it has been accumulated. In that case, if you donate to another trust from the accumulated income, that will not be considered as the application. So you can write down donation to trust from accumulated income. Okay, from the accumulated income. Any doubts so far? Yes, because corpus donation do not form part of the income. Yes, Mansha. Next is deemed application. Now here we will understand about the accumulation of income. So understand here one thing very carefully. As I said, 15% you can accumulate under both the regimes unconditionally, indefinitely. However, 85% of the income can be accumulated for a period up to 5 years. Accumulation of income is allowed up to 5 years, plus the condition is that the trust should submit Form 10 to the assessing officer. The trust should submit Form 10 to the AO specifying as to how it is accumulated. Okay, and it should be accumulated for the specified purpose in modes specified in 11.5. So the conditions for accumulation are that you should submit the Form 10 to the AO stating the purpose for which the income is being accumulated and the period for which you are going to accumulate. Can it be less than 5 years? Yes, it can be less than 5 years also. So submit Form 10 to the AO stating the purpose of accumulation and period. Are we clear? And the money so accumulated which is there will be deposited in the mode specified under section 11.5. Now, Form 10 is to be filed before the due date of return of income under 139(1). In case you do not submit Form 10, then the benefit of accumulation would be not available and the income would be taxed at the normal rates. Also, in case you are not furnishing the return of income before 139(1), then that will not be considered as the accumulation of income. So, Form 10 and return of income to be filed within due date of 139(1). Within the due date of 139(1). Now, when the accumulated income, as I said, is applied for the donation to other trust, that will not be considered as the accumulation. Clear? Now, understand one thing here particularly. When you deposit the sum for the purpose of accumulation, then that is considered as the deemed application. Right? That is considered as the deemed application. So that is considered as the deemed application. So you can write down, this is the deemed application of income. The money which is accumulated for the particular object shall be applied for that object itself. That is considered as the deemed application of income. If there is any violation, what could be the violation here? The violation could be, let's say the accumulated income is applied to purposes other than charitable or religious purpose or the objects of the trust. Or it ceases to be accumulated or set apart for application. Or you are giving the statement but you are not accumulating it, or you are withdrawing that amount. Let's say I have deposited in government securities and now I am withdrawing that amount. So it ceases to remain invested or deposited in any of these modes specified under section 11.5. Or it is not utilized for the purpose for which it was accumulated or set apart. Or you have made the donation to another trust from the accumulated income. Then it shall be deemed to be the income in case of violation, deemed to be the income of the previous year in which violation takes place. In which the violation takes place. So this has been the amendment of 2022. So if, let's say, for example, if it is applied for other than charitable or religious purpose, then it is deemed to be the income of the previous year in which it is applied. If, let's say, for example, if it is withdrawn from the mode specified under 11.5, then it will be deemed to be the income of the previous year in which it ceases to remain invested. If, let's say, for example, I am depositing or I am paying the funds to another trust out of the accumulated income, then it shall be deemed to be the income of the previous year in which it is paid to that trust. Or if it is not utilized for the purpose for which I have withdrawn, then it will be deemed to be the income of previous year in which the income is accumulated or set apart. Okay, so you can write down here. Applied to, the violation is applied for purpose other than charitable or religious or in accordance with object. then income of previous year in which it is applied. Second, ceases to remain invested as per mode under section 11.5 or ceases to be accumulated. Ceases to be accumulated. Then in that case, it shall be deemed to be the income of the previous year in which it ceases to remain invested. Ceases to remain invested. Ceases to remain invested or ceases to be accumulated. Okay. In case it is not utilized, for which it is accumulated. In case it is not utilized for the year in which it is for purpose which it is accumulated, then income of the previous year in which it is accumulated. Income of the last previous year of 5-year period or period for which it is accumulated is paid to other trust income of year in which paid or credited. Now we'll understand this one by example. Let's say, for example, we have accumulated the income in previous year 22-23 for 5-year period. 23-24, 24-25, 25-26, 26-27. This is a 5-year period. So earlier what used to happen, let's say for example, during this 5-year period, I'm not utilizing for the purpose for which it is accumulated. So it used to get taxed in the next year, 27-28. So 5 years starts from the current year itself. This is my current year. Now it will be taxable in the year, in the last period, in the last previous year of the period. It can be shorter than 5-year period also. Let's say if it is accumulated for 3 years, then in the last 3rd year. If it is accumulated for a period of 5 years, which is in our example, then it will be the income of previous year 26-27. So income of the last previous year, in this particular case, it will be deemed to be income of last previous year in case accumulated income is not utilized by the end of the period. By the end of the period. Are we clear? A screen is visible. I think it's not breached. Yes, that is the social trust concept which is there. Yes, Mansha, you're correct. I'm so sorry. I think there was some problem. Maybe the screen was not updating. Okay. But can you see now? You can write it down. I'm waiting for you to write down. So I'm just repeating it for your purpose since I think it was preached. So accumulation of income is allowed up to the period of 5 years. Condition is that you should submit Form 10 to the AO stating the purpose of the accumulation and the period for which it is accumulated. Maximum period can be 5 years, it can be shorter than that. Accumulation has to be in the mode specified under section 11.5. Form 10 should be filed along with the return of income under section 139(1). In case you do not file Form 10, then you will not be eligible for the accumulation of income. So accumulation of income, even if you are not utilizing in that year, you are accumulating the income, it will be considered as deemed application. In case of violation, what is the violation? Let's say, for example, if you're applying for purpose other than charitable or religious or other than the objectives of the trust, or it is ceased to remain invested, you are withdrawing from the mode specified in the 11.5, or it ceased to remain accumulating, or you are paying it to another trust. From the accumulated income, I told you, right, it is not considered as application of income. Rather, it will be considered as violation of the accumulation benefit. Then it will be considered as the income of the previous year in which the violation takes place. In case if the amount remains unutilized at the end of the period or the 5-year period which you have opted for, then it will be deemed to be the income of the 5th year or the last period for which you have opted, in case your income accumulated is not applied for the stated objective. Let's say I said I am accumulating the income for 5 years, I would be buying the building after 5 years for my hospital. But let's say I have not been able to do that, or I partially put the amount in building. Then at the end of the 5th year period, in the previous year, 26-27 in our example, it will be deemed to be the income. Last point before we close the lecture is deemed application under Level 1A. Deemed application under section 11(1)(a). Or we'll do 11(1)(a) maybe tomorrow, because I think it's already late. What we'll do is, you can just write down deemed application under 11(1)(a) here, and maybe we can do it tomorrow. You can write down meantime here, leave some space for the deemed application. Third point you can write down. Sorry. Deemed application as per explanation 2 to section 11. Now what is this? This is a small part. This 11(1)(a) is regarding the reinvestment of capital gain. This we will do it tomorrow because we will have to understand it. Money not received during the previous year. If the money is not received, you have included that if you are following the accrual concept. If you are preparing your accounts on the cash basis, then of course you would not include it and this will not be applicable. But let's say, for example, if you're following the accrual method of accounting. Now, in that particular case, let's say, for example, you have considered the income, but you have not received the income. So you have not received the income during that year if you are following the accrual basis of accounting. Applicable only for accrual basis of accounting. So you have not received the amount during the previous year. Then in that particular case, where the amount has not been received during the year, the application is extended to the previous year in which the income is actually received. and the previous year immediately following the year. So what you will have to write over here, amount not received during the current year, deemed application in the previous year. Deemed application in the previous year, but the money once received should be applied in the year of receipt or in the following year. In the year of receipt or in the following year. So let's say, for example, if it is previous year 22-23, where I have considered the income, but I have not received it, so it will be deemed application. But let's say I'm receiving it 23-24, then it will be considered as the application in 23-24 or in 24-25. Are we getting that? Non-application or shortfall in application deemed as income of the previous year following the year of receipt. So if you have not applied this income, then it is deemed to be the income of previous year 25. It is deemed to be the income of previous year 24-25. So the amount claimed has to be applied during the previous year or in the subsequent following year. Are we getting that? So let's say, for example, if my total income is 1 lakh, actual receipt is 60,000. Let's say 15% I remove from this. 15% I remove from this. So balance I have to apply is 45,000 during the year. Right? Let's say amount received in previous year 22-23 is 60,000. Amount received in 23-24 is 40,000. So out of 1 lakh, 60,000, 1 lakh is the total income of 22-23. Actual receipt is 60,000. So I will then consider here my deemed application entire 60,000, but I have to apply that amount in previous year 23-24 or 24-25. The balance 40,000 which I have not received. Since this amount is received in 23-24, this can be applied in 23-24 or 24-25. Then only the exemption is available. Are we getting that? Second case which is here is, income received on last date of previous year. Income received on the last date of the previous year. Now, if that is the case, if the income is received on the last year of the previous year, because of which it cannot be applied, then also it will be considered as deemed application. Let's say, for example, if it is received on 30th March. So it is impossible to apply the income within 1 day. Therefore, the sum can be applied at any time in the following previous year. That is 31st March 24. Are we clear? So therefore, it is deemed to be applied in 31st March 2024. But it will not be taken into consideration for determining the income of the previous year 22-23. or 23-24. Clear? Write down. Deemed application in the current previous year, but amount need to be applied in the next year. So you need to apply the amount in the next year. Any questions so far? Any questions so far? Again, for exercising the option for availing the extended period, whether in the case of income not received or income received on the last date, the trust has to make an option in the writing that the income may be deemed to be the income during the previous year in which the income was derived. And that option has to be exercised before filing the due date of return of income, again under Form 10. So you have to exercise the option in Form 10 before filing a return of income under Section 139(1). So income so deemed to have been applied shall not be taken into account in calculating the amount of income applied during the previous year in which income is actually received. So when it will be actually received, it will not be considered as deemed income. It is considered as income of current year, and therefore the deemed application is given. So in the first example I gave you, where 1 lakh was my income, 1 lakh will be considered as income. When 40,000 is received in the next previous year, then by virtue of the option under Form 10 exercised by the trust, this will be considered as income of the 22-23 itself. This will not be considered as the income of the 23-24. If it is not applied, then it will be treated as the income of the year in which the income was received. It will be deemed to be the income of the year in which the income was received. And in the second case, it will be deemed to be the income of the year in which it is derived. So you can write down. Not applied. If not applied, income deemed to be income of previous year in which it is derived, meaning the current previous year. Meaning the current previous year. Are we getting that? And in the first case, in the first particular case, it will be considered as the income of the previous year in which the income was received. In which the income was received, and not in the year. I made a mistake here. Income of the previous year. Here you can change it in year in which income received. So this is previous year 23-24 and not the next year. Sorry. Are we clear? The last one which is there, last point, application of the excess of the last year. So let's say, for example, in the last year, I have made the excess application. Let's say in the last year, my income was 100 lakh. I have made the application of 110 lakh. So there was excess of rupees 10 lakh. So will that be allowed in this year, just like the carry forward and brought forward of losses? Answer is no. So excess application of last year will not be considered as the application of income. So it is inadmissible application. Are we clear? It is inadmissible application. Are we clear? Yes or no? Any questions? Any doubt? Now the only thing remains is the capital gain reinvestment part. That we will do it tomorrow. Other than that, I have almost covered the computation of this particular income. But do not forget here one particular point before we close the session. We have almost considered the application which is there, but what is left over here? This mistake I made in my CA final exam, so I'm warning you not to make in your exam. And we are going to solve a sum tomorrow. What I'll do is I'll send you out the sum. Maybe you can download it from the website. Go through that question so that we directly discuss in the next class, so that we do not waste the time in the next class. But what is here important to be considered? The excess anonymous donation. That you need to add. Do not forget that. This will be, of course, taxed at 30%. So in our example, if you see, the excess donation was how much? 1 lakh rupees. So I will consider 1 lakh as the part of the total income, because this I will get through this as my total income. If I forget to add here anonymous donation, my total income will be wrong. So this I had made the mistake in my exam, that while computing the total income, I did not consider the anonymous donation. Clear? So mark that and do not make that mistake. And please revise before the next class. I'll send you out the question possibly tomorrow, so that you can go through the solution. But this is very, very, very important area. And the sum we are going to solve is from my attempt only, but of course with the modification. And that's why we will, that was a very comprehensive question in the CA final. We will just go through that. Jacob, what is the question? Whether we do couple of problems? Like, yes, we will do couple of problems here. That is for sure. Because that's how you will learn. That's why I'm even extending the class and trying to finish off, right? Thank you, Anarga. Good night. Good night, Jacob. So see you day after tomorrow. Okay. Thank you so much.